Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me to close out our live coverage at Money 2020 in Las Vegas, Nevada, we have Amias Gerety. He's partner at QED Investors to discuss fintech and bank partnerships, why they're becoming more common, where the opportunities are, and who has the advantage. Amias, it's great to have you with us. Welcome to TradeTalks.
My pleasure. Thank you for having me.
And I think this is a perfect way to round out our coverage here because you have such a bird's eye view of what's happening within the space. And I first wanted to start with some of the bank blowups that we saw in March. SVB, Signature, First Republic Bank. Financial services, we've seen these blowups on top of the challenging macroeconomic environment. It's increasingly getting more complex. What are you telling your portfolio companies when it comes to managing risk in this new world that they have to navigate?
So redundancy is the name of the game. And we think about that in two ways. One is true for all startups. You need to have multiple banking relationships. You should probably be putting some amount of your cash in treasuries. So we're just telling people redundancy, resilience, multiple relationships. But even more important for fintechs are the operational relationships with banks. And even there, it's so hard to get those relationships that too many fintechs thought, oh, well, if I've got SVB, that's all I need. And that's the real hard lesson for fintech these days, is you need redundancy in your partner banks. So this is one of the reasons why we're investors in Treasury Prime. They have 15 different banks with a single tech stack. So we're telling all the fintechs, you've got to get redundancy. You can work with Treasury Prime, you can work with others, but you've got to get redundancy in your operations because every bank can have problems, every bank can have risk problems, every bank can change their strategy, and you need resilience.
Well, I mean, if you think about it, a lot of the fintechs that are even here at Money 2020, they haven't really been through a volatile, high interest rate environment. I mean, if you think about it, an older fintech company may be 10, 15 years. We haven't seen this in 10, 15 years. So if you want some silver lining, this is a great teaching opportunity for you guys with your portfolio companies because these things do happen every 10 to 15 years, right?
Yes.
So we're seeing more and more fintech and bank partnerships become increasingly common, right? So where's the opportunity and who do you think has the advantage here?
Yeah, so I think again, partnerships is such an important word. We've talked about digital disruptors, we've talked about disintermediation. This is financial services. You need partnerships with banks. There is no fintech that moves money that doesn't ultimately need a bank partner. And one thing that we saw is too many fintechs were thinking of their bank partner as mere utility, just the rails. It was like turning on a light switch. It's on, it's off. When it's there, I need it. That's not how the real world works. These banks are your partners, and what we're seeing increasingly is whether that's being bought by or buying, every fintech needs to have a strategy to actually treat their bank as a real partner.
Right. Well, I mean, because the whole thing is, I think there's opportunities for both. You have the scale, but you're a big bank, and then you have what's it called? The
bank
ability,
sponsor banks,
but not even that, but the ability to be flexible and improve the technology as a smaller fintech. Let's talk about the IPO window for a moment here.
Absolutely.
It's opened. Been relatively lackluster, and of course I work for a fintech and exchange, so I want to be careful with my wording here. It's been lackluster.
Yes.
Do you think it's going to shut again? Will it pause? Do you think a lot of it is predicated on what's happening in the macro environment?
Well, the first thing I'd say is I don't think the IPO window is actually open for fintechs today.
Right.
So what we've seen is a couple of IPOs. They're not for fintech companies. And so what we're telling our customers, our clients, our portfolio companies, even if you think you're getting ready, think of it as a 2025 plan. Because one of the things that we learned in the last IPO window opening is that a lot of people came out too early. They weren't really ready for the discipline, the scrutiny. And that meant a lot of investors got burned. So what we're telling our companies is don't just come to the market bigger, come to the market different. Really have a story about why your company has learned the lessons of this little cycle and is coming to the market really ready, differentiated in terms of value proposition, but more importantly, differentiated in terms of scale, profitability, discipline, predictability. That's what public markets want. And I think for fintechs, that means that most fintechs who are thinking about IPO should be thinking about IPO in that 2025 window. Give people time to digest the learnings, come to market with a differentiated story about why you're not just better, you're not just a little bit, but you're actually a different kind of company.
Well, let's lift the curtain back for a moment here. What was the rush to go public? Was it investor pressure? Was it just, we just want to be public on the US capital markets? What was the impetus behind that?
I think it was as simple as public market valuations ran away even from private market valuations. And so that was the SPAC craze, right? As crazy as 2021 was in private markets, there were SPACs that were offering valuations that were 2x the private market valuations at the height. And if you're a founder and you have an opportunity to sell shares for a very low cost of capital, it's a rational thing to do. The fact that it didn't last, people are learning that lesson.
Yeah, well, I mean, the old expression, public investors get left holding the bag, so we want it a little bit more equitable for everyone. I would imagine we want trust in the companies you're investing in. Let's talk about the fundraising landscape, like
Absolutely.
what your expertise is. What opportunities are you seeing for VC firms right now?
So we see the Series A, so these companies with $1 or $2 million in revenue, there's a lot more value there than there was before. Part of that is that people are waiting a little bit longer. They're showing there's some proof in the pudding. They're showing something called product market fit. They're showing that customers really want what we're selling. And yet at the same time, those valuations have come back to something that feels rational. It feels like you can actually invest there and make money in the long term. You can be aligned for the long term. I think later stages, a lot more challenge. A lot of those companies have very large overhangs, very, very large valuations. But again, founders at that stage typically have built something with real value, and so we're also seeing a lot more pragmatism come in at the Series C, Series D. I think at the seed stage and at the Series B, there's actually still a lot more width in that bid ask.
Okay, but that's interesting then. Is everyone going to pile in on Series A, because that seems to be the sweet spot?
We certainly see that Series A's are starting. First they got valued, now they're getting competitive again.
Yeah.
But the standards have reestablished. You're seeing real traction. You're seeing people doubling in 6 months. You're seeing people get funded when they're tripling or quadrupling in a year. And that's the kind of momentum that venture scale outcomes are built on.
So what are you telling CD plus companies? Are you telling their founders you've just got to be patient and see what 2025 looks like?
Well, we're telling them get disciplined.
Right.
Do your customers want your product? If they do, are you charging the right price? If you're charging the right price and your customers want your product, how do you get to profitability on the cash that you have?
Right.
And if you get to profitability on the cash you have, congratulations, you control your own destiny. And if you control your own destiny,
well, that makes sense.
Maybe it's IPO, maybe it's acquisition, maybe you just grow a great company in private markets.
Right.
But one way or another, control your own destiny. If you're big enough to have been at the Series C and D, you probably should be able to control your own destiny, and that's the advice that we're giving our companies.
And that makes sense, right? If you want to IPO on the US capital markets, you're going to have the street analyzing your company, you're going to be public, so what you are telling them what they need to do, I mean, it doesn't get any more public than that when you're listed on an exchange.
Exactly, and the other piece of advice that I think a lot of people lost, it's so obvious, the IPO is not the destination. The IPO is a funding round just like anything else, and just like any time you're selling shares to an investor, they've got a return expectation. They want to come on that journey with you. And so I think sometimes founders lost sight of the idea that when you're public, you also still have shareholder relationships, and you want to bring them on that journey, just like we've been on the journey with our private companies for 5, 10, sometimes even longer years. When you go public, you're creating a new set of relationships, but those shareholders should want to stay on that journey with you, and that CEO, that management team, needs to be willing to go on that journey with the shareholders.
Excellent point, Amias. Appreciate the insight. Thanks for joining us on Trade Talks.
Thank you.
And thanks for joining me throughout Money 2020 in Las Vegas, Nevada. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.